Welcome to the Deep Dive. This is where we really unpack the key sources you've shared. Today, we're diving into the recent Booz Allen Hamilton earnings call. We'll cover their Q4, the full fiscal year 2025 results, and crucially, their outlook for fiscal 2026. Our mission here is to guide you through what management actually said about their performance, the market they're in, and where they see things going. We're pulling out the most important insights straight from that call.
That's right. We're using the call itself as our guide. Think of this as, well, your shortcut to understanding their perspective on the past year and what's shaping their view going forward, based purely on their words.
Okay, let's get straight into it. Looking back at the full fiscal year 2025, what was the big picture they painted?
Well, FY25 was a really strong year for them. They delivered results that actually beat expectations. They had over 12% revenue growth for the year. And the key thing here is almost all of that was organic.
12%, mostly organic. That's pretty solid.
Yeah, and adjusted EBIT grew by the same amount, 12%, hitting $1.315 billion. This actually pushed them past the top end of the target range they'd set way back in October 2021, so ahead of schedule.
Okay. They beat their own multi-year plan then.
Exactly. Their adjusted EBITDA margin landed at 11%, and they also saw over 15% growth in adjusted diluted EPS. So that was driven by the profitability and reducing their share count.
Makes sense. What about cash flow and deployment?
Generated really robust free cash flow, $911 million, and they deployed about $1.2 billion in capital. That included repurchasing around 4.3% of their shares, all while keeping a pretty healthy net debt to adjusted EBITDA ratio of 2.4 times. So yeah, the big takeaway is they exceeded those ambitious multi-year targets, mostly just through organic performance.
That really does paint a picture of a strong full year.
Yeah.
So how did the most recent quarter, Q4, specifically stack up against that?
Q4 also showed solid results, wrapped up the year well, although maybe it started hinting at some of the shifts they discuss later. Total revenue was up 7% year over year, hit $3 billion, again, almost entirely organic.
Still growing organically then.
Yep, and revenue excluding billable expenses, that was up 6%. Growth in Q4 was mainly driven by defense, that was up 14%, very strong, and Intel up 5%. Interestingly, their civil business was flat year over year in Q4.
Flat and civil. We'll probably come back to that. What about bookings and backlog?
Right, future work. Net bookings for the quarter were $2.1 billion. That gave them a book-to-bill of 0.71x. Management said that's pretty much in line with historical averages for Q4. The trailing 12-month book-to-bill, though, was 1.39x, which is above their 5-year average. So strong capture over the whole year.
Okay, so the full-year pipeline building was good.
Yeah. And they ended the year with a record backlog, $37 billion. That's up 15% year over year. Their qualified pipeline looking into FY26 is $53.4 billion. Now, that's lower than the record pipeline they had going into FY25, but it's still higher than it was going into FY24.
Okay, so strong numbers overall for FY25, building momentum into the year end. But you mentioned shifts. Management spent a lot of time talking about navigating a dynamic and changing environment. Presidential transitions, disruption. What exactly are they describing there?
They basically said that these transitions and even the lead up always create some near-term disruption. That's normal. But what's different this time, from their perspective, is that these dynamics need to be playing out faster than usual or faster than they initially expected.
Faster how?
Well, the focus of the administration, as they put it on the call, is really intensely on cutting government spending, boosting efficiency, and, fundamentally reimagining agency missions. For companies like Booz Allen, that means things like agency reorganizations, potential cuts in government staff and spending, and, importantly, a pretty comprehensive review of existing contracts. They noted these effects are hitting civilian agencies particularly hard right now.
So pressure on spending, contract reviews.
Right. But at the same time, they also stress the government is working to improve procurement itself. Things like revising the FAR, the Federal Acquisition Regulation. This is pushing expectations towards more fixed price and outcome-based contracts, getting paid for results, not just hours.
Outcome-based, right? That seems like a big shift.
It is. And alongside that, there's a huge focus on upgrading old legacy systems and bringing in advanced tech, especially AI, much faster.
Okay, so that's the environment. This focus on efficiency, contract reviews. How did that specifically impact their results? You mentioned the civil business was flat in Q4.
Yeah, this environment had a direct hit there. It led to a slowdown in awards and changes to contract run rates, specifically in civilian agencies. Management actually called out 5 specific large technology contracts in their civil portfolio where the run rates have been cut significantly.
Cut significantly. Why?
Directly tied, they said, to the administration's push to reduce overall spending. They estimate that specific impact creates about a 3% headwind to the entire firm's revenue for FY26, just from those 5 contracts.
Wow, a 3% firm-wide headwind just from those civil contracts being reduced.
Yeah. And then, layered on top of that, this slowdown happened right as a large tech contract at the VA ended that was a previously disclosed lost recompete. That one specific contract ending adds another roughly 3% headwind to their consolidated top line for FY26.
So you're looking at a combined, 6% headwind just from those 2 factors hitting the civil business?
Exactly. A combined roughly 6% headwind, distinct issues but hitting simultaneously. And this combination also meant a whole lot of employees needed to be redeployed very quickly. They said that's been challenging because the overall procurement environment has slowed down too. Harder to find new spots immediately.
A 6% headwind and redeployment challenges sounds like a major transition needed for civil. What steps are they actually taking to deal with this?
Yes, they acknowledge these factors and expect them to continue in civil for a bit. So they've decided to restructure and essentially reset the civil business. This means targeted cost and headcount reductions.
Like what specifically?
They mentioned reducing their bench, that's employees waiting for projects, also delayering management, so fewer layers of leadership, and adjusting infrastructure costs, all to match what they now anticipate demand will be. They called these difficult decisions naturally, but necessary now, to position civil for future growth and, importantly, to preserve their ability to invest in other strategic areas.
So what's the expected impact on civil's numbers next year?
They anticipate civil revenue will likely decline in the low double digits in FY26 because of this reset. But they do expect the business to rebound later as those big government transformation and efficiency drives start generating new kinds of opportunities.
Okay, a reset now for a rebound later. Let's pivot from the challenges to the opportunities they mentioned. They seemed quite positive about collaboration with the GSA.
Yes, this is where they highlighted some potential upside. They talked a lot about the GSA, the General Services Administration. GSA has this stated goal to transform and centralize government procurement. They're hunting for big efficiencies, cost savings, and ways to inject tech like AI across the board.
And Booz Allen's role.
Apparently, Booz Allen was in the very first group of companies that GSA brought in for a review exercise. They said they've built a really productive relationship. 2 key outcomes they mentioned. First, GSA got a better understanding of Booz Allen's value. Second, and maybe more strategically important for Booz Allen, they now have this unique opportunity to kind of offer input on accelerating that move to outcome-based procurement government-wide. And also how to effectively bring in things like agentic AI capabilities into those new contracts.
Agentic AI. That's AI that can act on its own, right? And you mentioned outcome-based procurement again. How big a deal is that shift for a company like them?
Management framed it as huge. They actually said they've been arguing for years that the government needed to move this way to be more effective. They seem really optimistic that this whole process, which maybe would have taken a decade before, could actually accelerate under this administration, with GSA leading the charge.
So a faster shift to paying for results.
That's the idea. Their belief is a more efficient government will just buy differently. More commercial tech, focus on outcomes, streamlined processes, more speed. They think this sets the stage for a, quote, new kind of growth in the government market down the line, one that favors companies who can deliver those specific outcomes.
And how does their own strategy fit into this? They mentioned their VAULT strategy.
Right. VAULT stands for Velocity, Leadership, and Technology. They feel it's perfectly aligned. They believe they've got a leading position in the key technologies driving this shift, especially AI. They also highlighted their track record building partnerships from startups through their venture arm, Booz Allen Ventures, all the way up to the big hyperscalers, the cloud giants. Right. And they're focused on areas like cutting duplication and cost while also boosting readiness and lethality for the military. They see VAULT hitting all those points.
Let's drill down more on those technologies then, especially AI. They gave some specifics there, didn't they?
Oh yeah, AI was a major focus. They reported significant and increasing demand across government. In FY25 alone, their AI business grew over 30% year over year, hit about $800 million in revenue.
$800 million just in AI.
Wow. And they're seeing agencies invest more and move towards actually implementing it at enterprise scale. It's becoming foundational, not just experimental. They gave examples in defense and intel using AI for faster image analysis with computer vision, better decision-making with custom generative models, delivering autonomous systems. They feel their decade-plus investment here really positions them to lead this next wave of AI transformation in government.
The partnerships play a big role in that tech strategy, too.
Definitely. They stress strengthening those private sector partnerships. Being a leader in that whole tech ecosystem, they're building on their track record of, accelerating adoption of commercial tech for government missions. They just announced a new collaboration with NVIDIA, actually, combining their AI and 5G, 6G know-how with NVIDIA's tech to speed up delivery of edge applications.
Edge applications, like out in the field.
Exactly, places with limited connectivity. And they continue investing in early-stage tech through Booz Allen Ventures. Their whole philosophy seems to be stronger together, develop some stuff in-house, but heavily leverage partners, too.
Makes sense. What about cloud? That came up, too, right? Cloud migration?
Yes, cloud migration and consolidation, another key area. They said they're talking to multiple agencies about speeding up cloud adoption and, crucially, consolidating thousands of old data centers into cloud architectures. The main goal is making huge amounts of government data more accessible, more usable.
Why is it so important now?
Well, they pointed out the private sector already did this, finding it more efficient, cheaper, and more secure, which aligns directly with the administration's efficiency push. And critically, making that data available is seen as essential for applying advanced AI tools effectively, especially for the military, to increase readiness and lethality. You need the data accessible first.
So the cloud enables the AI. That makes sense. Did they give a concrete example of this tech stack in action?
They did, a really good one. They talked about working with the U.S. Army, building an AI-enabled tactical software system. The prototype's goal is to drastically cut the response time to threats, from like a typical 15 minutes down to just 1 minute.
15 minutes to 1 minute. How?
By using AI for faster target recognition and then streamlining the whole process of calling for fire support, that kind of speed increase is exactly the tangible benefit AI promises.
Wow, yeah, 15 to 1 is a huge impact. That's the kind of thing that gets attention. Okay, let's shift to looking forward. What are their specific operating priorities for FY26, given all these moving parts, and what's the actual financial outlook they provided?
Okay, FY26 priorities. They're clearly focused on navigating this transition and setting up for future growth. They listed 5 key things. First, reset and restructure, civil like we discussed, aiming to get it back to growth quickly after this adjustment. Second, position to lead and win those big outcome-based deals. That includes rethinking how work gets done, like using AI to speed up software development, delivering more value for less cost.
So leaning into the changes.
Exactly. Third, pour significant resources into specific growth spots, missions in the Indo-Pacific and space, and critical tech like agentic AI, quantum, software-defined communications. Fourth, rapidly advance partnerships, both with the big established tech firms and new entrants, really going to market together, becoming scaling partners. And fifth, keep finding efficiencies in their own business, getting leaner, faster, to free up cash for investment and drive shareholder value, even now.
It seems like a clear plan. What about the numbers, the FY26 guidance? They mentioned less visibility, right?
Right. They framed the guidance within that dynamic environment, acknowledging visibility isn't quite what it usually is. For revenue, they expect between $12 billion and $12.5 billion. Adjusted EBITDA in the range of $1.315 billion to $1.37 billion.
So EBITDA roughly flat to FY25, maybe slightly up at the high end?
Pretty much. That implies a full-year adjusted EBITDA margin around 11%, basically holding steady with FY25 despite that civil reset, which is interesting. Adjusted diluted EPS, they expect in the range of $6.20 to $6.55 per share. That assumes, tax rates around 23-25%, slightly higher interest expense, and importantly, no real impact from their venture investments in that core guidance. And free cash flow expected between $700 million and $800 million.
Okay. And did they talk about the cadence they expect the year to play out?
Yes, they did. They anticipate revenue and profit growth will be comparatively lower in the first half, particularly in the second quarter. That's partly due to tough comparisons with last year and also the timing of those one-time actions, like the civil restructuring hitting. Then they expect a meaningful reacceleration in the second half of FY26.
What drives that second half pickup?
They pointed to their strong backlog, the size of recent wins they haven't booked revenue on yet, the ongoing opportunity pipeline, and a key one. They expect a meaningful uptick in hiring in the back half of the year.
Hiring pickup in H2. Okay, that expected shape of the year, softer first half, stronger second, seems really key for investors. Speaking of investors, the Q&A section usually gives great context. What were the big themes or tough questions that came up, and how did management handle them?
Yeah, the Q&A was revealing a major theme was definitely around their comfort level. Like, could there be more contract cuts or cancellations coming given the government reviews? Management acknowledged those two sets of overlapping dynamics, the civil reset pain versus the defense intel strength. But they stated they think most of the significant civil reviews are largely done now.
So they feel the worst of the civil review impact is known.
That seemed to be the message. They said actual cancellations have been pretty rare, maybe 1% of the portfolio, mostly older consulting stuff. They emphasize they're seeing new opportunities forming in civil, while defense intel procurement stays strong. The key point was they did the restructuring now to position for growth, implying they don't see huge risks of more widespread cuts derailing things further.
What about longer-term growth? How did they frame the defense versus civil split in the context of budgets?
Right, investors definitely pushed on that. Management basically aligned their outlook with the expected budget picture. Defense likely getting a plus up, civil discretionary spending potentially facing cuts. They highlighted how their investments align with defense priorities, Indo-Pacific, space, homeland security, injecting AI. That's where they see near-term drive. They reiterated civil will rebound, but it'll be driven by those newer transformation and outcome-based deals gaining traction over time. So focus is on defense intel momentum for now.
You mentioned civil rebounding later. Was there discussion on the catalyst for that? What actually makes civil stabilize and improve? That H2 story sounds critical.
Absolutely. That was a focus. Management reiterated that most programs have been reviewed. They see the current civil slowdown as agencies just pausing to figure out how to tackle bigger transformations and adopt new tech. They stressed winning now requires top tech skills. They mentioned their own cloud, AI coding, agentic AI, plus a vision for how tech evolves and a willingness to do those outcome-based deals. They think the pivot for civil comes from extending their capabilities to speed up missions under these new rules. So yeah, they expect H2 growth as that new procurement approach gets clearer and deals get awarded.
Okay, what about the headcount cuts? How does that square with their usual growth model?
Good question.
Yeah.
They acknowledged the roughly 7% total headcount cut in Q1, heavily weighted to civil. They explained that their old rule of thumb headcount growth plus maybe 3% for mix efficiency equals revenue growth is just less precise now.
Well, less precise.
Several reasons. Backlog converting to revenue is more variable now. The shift to outcome-based deals means revenue might not track headcount hours as closely, even if margins improve over time. And the cuts were focused in civil, which has more fixed price work anyway. They said the old model is still decent for defense intel, but the key insight is they're actively managing costs, cutting in one area, but still planning significant hiring in H2, even using tech to recruit faster. Headcount alone isn't the full story anymore.
That makes sense. Did the topic of government wanting commercial terms, even in defense, come up? And Booz Allen's tech investments?
Yes. Management sees that trend accelerating. They leaned into their partnerships, from the big guys down to startups. They see themselves as ideal partners for missionizing commercial tech, adapting it for government needs, adding their own layers for tough environments. They actually framed more commercial tech use in defense as a net positive for them because of their partnerships and investments, like in Shield AI and their venture portfolio.
Interesting perspective. What about branding? Did investors ask if they have a perception issue, maybe being seen as just legacy consultants?
Someone did bring that up. Management acknowledged they get written about a lot, but historically they've been quiet, letting clients take credit. Their response was basically, we need to get better at telling our story. Publicly and privately, talking across the administration, making sure people understand their advanced tech position. They believe as people interact more with their actual tech solutions, the brand perception will naturally shift.
Makes sense. Were they optimistic about specific big AI programs like Advana or Thunderdome?
Oh, extraordinarily optimistic about AI overall. They see it as a core strength getting embedded everywhere. Their focus on those big programs is implementation speed and making commercial tech truly mission-ready, safe, reliable. They feel they have the track record. They sounded particularly excited about agentic AI, adversarial AI defense, and that convergence of cyber, AI, and space. They mentioned a project called Space Llama. The insight is success comes from blending top commercial tech with their own specialized stack, and they're trying hard to convert these to outcome-based deals.
Okay, two more quick ones from the Q&A. Industry consolidation and margins.
Right. On consolidation, they noted the industry's fragmented. The current dynamic is more about market share shifts and new defense tech players entering. They positioned Booz Allen as being aggressive, strategically advantaged by Vault, and on the side of change, embracing the shifts. While FY26 Civil is tough, they're very optimistic medium-long term. On margins and non-client headcount, they said they're managing costs aggressively everywhere. Civil used to be more profitable, but they're pleased they can hold overall margins flat while restructuring it and investing, getting leaner. But they cautioned not to expect near-term margin upside from the reset itself. Long-term, outcome-based shift has potential, though.
That covers a huge amount of ground for you. From those strong FY25 results beating targets, through the disruption and the big reset in Civil driven by government changes, to the strategic pivot towards outcome-based work, that heavy lean into AI and partnerships, and finally the FY26 outlook with that H2 reacceleration hope and all the key investor debates.
Exactly. It really shows a company actively, responding to a market that's changing fast. They're facing real headwinds near term, no doubt, especially in Civil, from specific spending reviews and procurement shifts. But they're proactively restructuring, while also seeing big opportunities elsewhere, driven by efficiency demands, new contracting models, and especially advanced tech like AI. Their strategy, partnerships, tech focus, that's what they believe positions them for growth, despite the current choppiness.
So for you listening, seeing how a major player like Booz Allen navigates these big macro political and budget shifts, seeing the direct impact on specific segments, how it forces strategic change, operational moves like restructuring is really valuable context.
Absolutely. It really shows you that complex dance between government policy, how fast tech actually gets adopted on the ground, and how companies have to adapt their strategy, their people, their whole operation, basically in real time.
All right, now for our This Is Not Financial Advice segment. Always remember that. Okay, given the heavy focus in the call on outcome-based contracts, those very specific Civil headwinds from spending reviews and management acknowledging the challenge of redeploying talent quickly, here's a purely hypothetical, maybe outrageous but plausible trade idea for you to consider.
Uh-oh, let's hear it.
What if you set up a pair trade, betting on the relative performance between Booz Allen and maybe a competitor that's much more defense-heavy, much less exposed to that Civil disruption? The idea would be you conceptually shirt Booz Allen's near-term path, maybe focused on that Civil headwind and redeployment friction, potentially dragging out that H2 rebound they hope for, perhaps using options or just tracking relative stock performance. And simultaneously, you go long a pure play defense tech firm, one tightly focused on those urgent, less discretionary budget areas like Indo-Pacific or space systems.
So playing the divergence they themselves described.
Exactly. The thesis is built entirely on their own commentary about those uneven market dynamics, betting that the real-world friction in that Civil reset and talent shuffle takes longer to work through than maybe hoped, while the defense spending pipeline keeps flowing more smoothly for others, at least in the near term. It's a total thought experiment, of course, playing directly on the segmentation and the pacing differences they laid out.
That is specific, and it definitely leverages the precise segment dynamics and those timing differences management highlighted right there in the call. That potential gap in near-term execution across different government markets is certainly a key takeaway from their commentary.
Indeed. Purely a thought experiment, folks. Remember, this is definitely not financial advice. Okay, that wraps up our deep dive into the Booz Allen Hamilton earnings call. We've hit the results, the market dynamics, their strategic responses, and the outlook.
Thanks for joining us for this deep dive. We hope this breakdown gives you some valuable insight into the company's performance and how they see the path ahead, straight from their own words.
We always encourage you to take this information, dig deeper, do your own research, and form your own conclusions.
Thanks for tuning in.
We'll see you on the next deep dive.